Don't be fooled into thinking the Fed is done raising interest rates. Last week's release of the minutes of its most recent meeting revealed that the Fed's leaders are determined to stay the course in fighting inflation, despite Chairman Jerome Powell recently discussing disinflation. The Fed has been raising interest rates since last spring, resulting in money flowing out of all assets and causing mostly crashing markets. However, the stock and crypto markets have been rallying since late autumn 2022, as investors anticipated lower rates and leveraged traders were forced to cover short positions. This rally seems to have peaked in early February, following Jerome Powell's announcement that inflation was starting to come down, and the jobs report for January revealed that the U.S. economy had added 512,000 jobs, putting unemployment at 3.4%. This, in turn, means the Fed has room to raise interest rates even higher. However, the Consumer Price Index and Producer Price Index for January both came in higher than expected, while the Fed's favorite inflation measure, the Personal Consumption Expenditures, rose, suggesting a second wave of inflation. Against this backdrop, the Fed released the minutes of its most recent meeting, revealing its determination to stay the course in fighting inflation, despite the concerning inflation data. Although the first two mentioned aspects remain below pre-pandemic levels, the number of auto loan defaults has officially surpassed pre-pandemic levels. While the number of mortgage defaults is likely to remain low, it is not possible to have a fixed rate on credit cards. Fixed rates on auto loans are possible, but they are not that popular. This means that we could see more credit card and auto loan defaults. Fed officials do not seem to be a fan of this setup, as they take issue with the fact that housing costs remain abnormally high in most of the country. They also took issue with the fact that most stocks remain overvalued relative to historical price-to-earnings ratios, despite all the interest rate hikes. This relates to the fifth part of the minutes, which covers the Fed's economic outlook. It sounds like the new Fed members are more optimistic about the U.S. economy than their predecessors. That said, don't expect to see the U.S. economy start to pick up until next year, and even then, growth will be low. The new Fed members also think that inflation will fall faster than their predecessors did. That said, they still believe that inflation will still be well above the Fed's 2% target by the end of the year. Regardless of the measure, this contrasts with investors who believe inflation will fall below 2% by the end of 2023. What's scary is that Fed officials don't expect inflation to return to the Fed's 2% target until 2025. This assumes that the U.S. economy hasn't entered a new regime, which is possible if not likely. The TLDR is that things like the onshoring of supply chains and low employment could keep inflation high. When it comes to current economic conditions, Fed officials emphasize that inflation is still too high and that it's going to take a period of below-trend growth to bring inflation back down to 2%. This is code for recession, which the Fed officials continue to see as likely to occur in 2023. Fed officials believe it's possible that the labor market is strong, in part due to the fact that it will be difficult for employers to find replacements for any employees they fire. It's also strong in part due to a general shortage of manpower in the services sector, primarily due to retirements. Fed officials also express concerns over the possibility that inflation expectations could become entrenched if inflation continues to stay as high as it has been. That's because high inflation expectations would lead to behavioral changes that could cause even more inflation. During a recent meeting, some officials in the Federal Reserve advocated for a 0.5 rate hike, which, in hindsight, would have been more appropriate. The Federal Reserve confirmed that it would continue to sell government debt from its massive balance sheet each month, which would increase interest rates. However, the debt ceiling has dampened this effect, as the Treasury is unable to issue new debt. The Federal Reserve's most recent minutes indicate that it is still fighting against inflation, and it is not clear how much damage it will inflict on the markets with its hawkish rhetoric and rate hikes. The Federal Reserve risks causing a catastrophic crash if it is too hawkish or raises interest rates too aggressively, which would force it to lower interest rates prematurely and lead to higher inflation. Although the Federal Reserve officials want the markets to crash, they want it to happen in an orderly manner to avoid breaking the financial system. Therefore, the Fed is playing dumb in the public eye, and we might see a slow and orderly decline in all assets, rather than a sudden crash. However, many black swans, such as the debt ceiling, could cause a crash. When the debt ceiling is raised, the U.S. government will be allowed to issue new debt, creating selling pressure for bonds that could cause a sudden spike in interest rates and market volatility. This sudden spike could lead to stocks and cryptocurrencies crashing. Additionally, Japanese investors selling off U.S. assets to take advantage of higher interest rates at home, and governments on bad terms with the U.S., such as China, selling U.S. debt, could further exacerbate the situation. Thanks for joining me today, and I'll see you next time.